Welcome to the International Tax section of Withum's Business and Finance Symposium. Today we're going to be talking about some current and forthcoming national and global tax changes. Manpreet Sangha and I will be talking about the Corporate Transparency Act, and then we'll have Calvin Young and Lindsey Dickey talking about some really interesting tax cases that are coming to the Supreme Court this session, and then we'll close out with some transfer pricing updates. So, Manpreet, you want to get us started with the Corporate Transparency Act that is going to come into effect this January?
Sure. Thank you, Kimberlee. So we'll start with the Corporate Transparency Act and just go through a little bit of the background of the new rule and go through some of the reporting requirements and most critically the exceptions from needing to report beneficial owners. So we'll start with some background here. Next slide. So what is the Corporate Transparency Act? The Corporate Transparency Act is the product of a 2016 Financial Action Tax Force report that basically kind of highlighted some of the weaknesses in beneficial ownership reporting, and really the priority here is to strengthen the legal framework around that reporting and bring some sort of standard to the way information is collected during entity reporting formation processes, and really just trying to have a more federal level oversight of the process. So we're looking at a couple of jurisdictions here. We've listed them out. That really it's quite simple to organize an entity. So I think the aim of the CTA is to put a little bit more structure around that process and collect a bit more information about beneficial owners and the people forming these entities.
And this type of information that's going to be collected, while it's very new in the US, in foreign jurisdictions, this is collected right at the outset. If you're trying to form an entity in the Netherlands or in any other foreign jurisdiction, this information is collected at the outset. And that's often why it takes so much longer to form an entity in a foreign jurisdiction than it does in the US. Next slide, please.
So as we highlighted on the previous slide, the purpose of the CTA, again, to set that clear federal standard for incorporation practices, national security. It's always a concern. So again, gathering information, more information reporting, protecting interstate commerce, and again, these international AML and CFT standards that Kimberlee was just referencing. In other parts of the world, I mean, this is pretty common practice. And we've even seen in the US, a couple of cities over the past few years have started to require a bit more information reporting around beneficial owners, particularly in the real estate context. But that's really the aim of the CTA here, is to establish that federal standard, begin gathering more beneficial owner information, and really, start aligning U.S. practices with more international norms. Next slide.
I'll take this one, Manpreet. So what is it? So each reporting company has to submit to FinCEN. And what FinCEN is it's part of the Treasury Department. And that's, if you've heard of FinCEN before, that's where you send your foreign bank account reports if you have a foreign bank account and you have to file. So it's part of the Treasury, but it's not the IRS. It's where you'll have to send a report online where you identify each beneficial owner of each reporting company and each applicant. And an applicant is someone who is forming a company with respect to that company. So who is a reporting company? Well, it's a corporation, an LLC, or a similar entity. And if it's domestic, you're created by forming a company with the Secretary of State. Or if you're a foreign entity, if you have to register with a company and get authority to do business in a state, with the Secretary of State or under the laws of a state or a foreign tribe. So anytime you're forming an entity or getting authority to do business in a state for an entity, that is going to trigger now a reporting requirement with FinCEN under the Corporate Transparency Act. Next slide. But here comes the fun. The exceptions.
Right, Kimberlee, I'll take this slide. So we're going to get into a bit more detail on those three definitions, but we wanted to highlight the exceptions right up front because, as you can see here, there's quite a few. Looking at the left-hand side of the slide, you see a lot in terms of financial services, right? So a lot of exemptions in the financial services world. Really, any registered entity, any regulated entity, even investment advisors, public accounting firms are exempt. So there's a couple more on the right column, tax exempt. So there's a wide variety of exceptions, and these are the industries that you'll see exceptions in. And then on the next slide, we also highlight here large corporations are exempt, right? So any corporation in the U.S. with more than 20 full-time employees, more than 5 million in gross receipts, and with a physical operating presence in the U.S., all those corporations are exempt. So, your operating companies in the U.S. Will find this exemption to be useful. Dormant corporations as well, and these are truly dormant corporations, right? Not, entities with minimal activity going through them, but it's a truly dormant corporation that doesn't hold any assets, has not received more than $1,000 in the last 12 months, and no ownership changes. So dormant corporations are also exempt, but again, just making sure that you can tick through those few requirements is important there.
So with that, so you say, okay, I have not fallen into one of those exceptions, so I do need to file a report. So what do I need to report? You need to report your beneficial owners. So who are your beneficial owners? So it's any individual who directly or indirectly either exercises substantial control over the entity or who owns or controls 25% of the ownership interests of the entity. So you don't include your non-senior officer employees who control or have economic benefits from the reporting company, and that's solely because they're employed by the company. So you're not including your employees, but if you have a chief financial officer or a chief operating officer who owns the company, they would need to report. So we're really looking at substantial economic control and someone who's truly controlling and beneficially owning the company. So a lot of closely held corporations will need to report here. Next slide. And then we have the applicant. And the applicant is really that person who is going to report when you are first registering the company or you have a new company. And that's the person that's responsible for the filing. So there's going to be information that you're required to report on both the applicant, the person who's filing, and on the beneficial owners.
And so, Kimberlee, that's the person who's filing that certificate of incorporation document. So I presumably that'll be legal counsel most of the time. That'll be the applicant. Yeah. So that's just an interesting new role that they'll be taking on as well as part of this process. So in terms of required information that the reporting company needs to disclose, full legal name, that's should be obvious, DBA names. For the domestic companies, the address of the principal place of business, state of formation, and the IRS EIN or tax ID number. That the IRS tax ID number, that's an interesting one because that's usually applied for as part of the formation process. So again, just pulling all that information together in one place, you'll see that being the consistent theme here. For foreign companies, the address or primary location in the U.S., the state where they're first registered, right? Not necessarily formed because they weren't formed in the U.S. And then again, that tax ID number as well. And I think there might be one. Okay.
Yeah, and then there's that alternative FinCEN number if they apply for a FinCEN number. And then you're going to need the same information about the beneficial owners. Well, not the same, but they'll want their full name, legal name, their date of birth, where they're resident, and then they'll need a unique identifying number from a non-expired document. And this is interesting. They will want if you're a U.S. person, your U.S. passport, driver's license number, or other identifying number, a document number. If they're a foreign person, they'll want the foreign passport. You'll probably get some pushback, especially from your U.S. persons on this, but this is actually what is required if you are trying to form a foreign corporation. In the Netherlands, they will ask for a copy of the passport of every beneficial owner of a corporation. So they're already asking for this overseas. And alternatively, you can get a FinCEN identifier if you don't have one of the above documents. So it is pretty inclusive of what they're asking for on their beneficial owners. And again, all of this is going to kind of those anti-money laundering regulations that they're trying to gather information on what's going on with their companies, and they're trying to get some full transparency here. Next slide. So again, this is the applicant. And so this is that person forming the company, and this is only required for new reporting corporations. So any new entity that was not in existence on January 1st, 2024, they will have an applicant, and they have to file this Corporate Transparency Act report within the first 30 days of formation, although that might get extended to the first 90 days, but it's right now the first 30 days. And it's the same information, pretty much the same information of a beneficial ownership, but the beneficial owner, but this is for the person who's forming the company. Next slide. And here you want to take this? This is
Sure.
the dates.
Yeah, so the reporting again starts in the 2024 calendar year. So entities formed on or after January 1st need to file a report within 30 days of formation. And entities formed before January 1st, 2024 have a year to file. They can't file any later than January 1st, 2025. If there's any change in information or change in ownership, an updated report needs to be filed within 30 days. And if there's a correction or a change that needs to be made, that report needs to be filed within 30 days of becoming aware of that information inconsistency. Next slide.
And
violation. Yeah, go ahead.
Go ahead.
I was just say this is the question that everybody asks, right? Well, what happens if I miss this, or what's the penalty? The penalties are up to $500 per day, up to $10,000 in total, and imprisonment. So it's quite severe. The penalties, and again, there's this willful standard. So I'm sure that'll be, that'll be a point of what is considered willful. But the penalties are pretty clearly defined, and do include imprisonment.
And this is an interesting part of it. We won't go through this in too much detail, but FinCEN can disclose this beneficial information. It's limited to who they can disclose it to, but it can be disclosed. It can be disclosed to federal agencies involved in national security and intelligence and law enforcement. It can be disclosed to financial institutions due to customer due diligence. It can be disclosed to federal functional regulators or appropriate regulatory agencies, and to law enforcement. if they need it to comply with a treaty or for limited investigation. So it's not that it's going to be kind of totally enclosed right there with the Treasury Department. So there will be some information sharing. So it's not like the IRS where it's totally blocked in and enclosed. So there will be some information sharing. Again, they can reject a reason for sharing it for good cause, but they have said that they will share it, and they will share it with the IRS. So get ready.
Right. And Kimberlee, I think again, this is kind of the common theme, right? It's like the cross referencing of information, just making sure things are lining up. Here are some of the tax enforcement uses of this information. Um, Identifying taxpayers for exam. The IRS has quite a bit of additional funding that they're using for enforcement. So I would expect this information to be used there. Um, simplify identification of persons and entities affiliated with taxpayers. So again, just kind of connecting taxpayers to one another, and then monitoring compliance with reporting rules. Again, making sure that information returns are being filed appropriately, and the interplay between the CTA and FATCA and FBARs. I'm sure they're going to start trying to draw some connections between the three. And then assist in locating potential sources for collection of tax liabilities, right? So again, looking for property to enforce collections. So these are some of the uses that we can expect.
Now, on the flip side, if the information gathered through the CTA is knowingly disclosed in an unauthorized manner, there are penalties for disclosing that information illegally. So, as you can see, those penalties are very severe. So you can see that if an employee of the Bank Secrecy Act or someone discloses your information illegally, there are even more severe penalties than there are for not providing the information. So they are taking this security of this information seriously, but they will be using the information.
And so, we'll wrap this up for the CTA portion, but this is a rule kind of laying out kind of where we're going from here, right? Rulemaking regarding the beneficial ownership registry, how this whole process is going to work in terms of filing these reports, development of that beneficial ownership secure system, again, and the infrastructure to actually do the reporting. I think that's what we'll be looking towards as we come into year end here, just logistically how these reports will be filed. But in terms of the rule itself, that seems pretty well defined, right? And the timelines for reporting are well defined. So now it just becomes a matter of, well, how do we file these reports? And I think we'll have some clarity around that in the coming months.
But one of the key things we need to advise you of is that right now, that providing guidance on the Corporate Transparency Act could rise to the level of practicing law. And that is going to be defined by the states. It's a matter of state law. And so until the states can provide conclusive or actionable guidance on how non-attorneys can provide CTA services, only licensed attorneys can provide guidance on CTA. So we encourage you to contact your attorney, your corporate attorney, to request guidance on CTA. And then we can work with your attorney on how to help you get in compliance with the CTA. Thank you, Manpreet. And I believe at this point, we're going to turn the presentation over to Calvin and Lindsey to talk about some really interesting recent court cases that are coming up before the Supreme Court this session.
Thank you, Kimberlee. So as Kimberlee kind of introduced, next up, Lindsey and we're going to talk about a couple interesting U.S. tax cases that are relevant in the international tax arena that are coming up to be heard by the U.S. Supreme Court, as well as some potential considerations to think about now. So the first case that we are going to discuss is the Moore case. And this was a case where the taxpayers challenged the constitutionality of Section 965, the mandatory repatriation tax, also known as the transition tax, as it violates the U.S. Constitution as a direct tax that has not been apportioned among states. So some background that we can provide some background before we get into the case. So the Constitution provides that direct taxes must be apportioned among the state. So essentially that means that each state pays in proportion based on its population. So usually this requirement is a bar for the federal government to impose these types of taxes. However, the income taxes are exempt from this rule, so they do not have to be apportioned. So one of the questions in this case is, does the income tax require a realization event to have income, which we'll get into the discussion that the court had. Uh, and then also some other background regarding Section 965. That was a piece of legislation that was enacted as part of the Tax Cuts and Jobs Act in 2017. And it generally required U.S. shareholders to include amounts of accumulated earnings in the foreign corporation into their income on a current basis, even though no actual distribution was made. So Section 965 and correspondingly GILTI, those rules were aimed at ending deferral of earnings in the foreign corporations that were owned by U.S. persons. The Section 965 did provide some beneficial tax rates for bringing that income back and getting recognized in the U.S. So some of the facts around this case: the taxpayers, the Moores, they owned an 11% interest in a controlled foreign corporation. I believe it was an Indian corporation. And they never received any actual distributions from the corporation and also never disposed of the stock. And then with the enactment of Section 965, the taxpayers were required to include their pro rata share of the cumulative earnings in the CFC in the income. And then they were hit with a significant tax liability as a result of the 965 rules. So the taxpayer argued that the tax was on earnings that they never realized from the CFC, and that the government had imposed a direct tax without it being apportioned to the states. So that went against the unconstitutional tax. So going to can you flip back one slide? Yep. So the history of this case, when it was first brought to the district court, the court dismissed the case based on saying that the plaintiffs didn't state a claim. The plaintiffs went on and appealed the case to the Ninth Circuit, and the Ninth Circuit affirmed the district court's dismissal and upheld the mandatory repatriation tax. So the question here was, is Section 965 a tax on income under the 16th Amendment of the Constitution, or a direct non-income tax that should have been apportioned among the states? And the taxpayer argued that the 16th Amendment exception from apportionment, that requirement that the tax must be apportioned, is only applicable to realized gains or income that they never realized any income here because they never disposed of the shares, and they never received any distribution from the foreign corporation. So the court ultimately decided that the realization requirement was not necessary here as a requirement for an income tax. And a couple interesting excerpts from the case. We listed a couple here below on the slide. And the first statement they made, the 16th Amendment exempts from apportionment the requirement, the category of incomes from whatever source derived. So that's saying what I mentioned before, that it's only an income tax doesn't have to be apportioned, but all other taxes do. And they also state that the realization of income does not determine the tax's constitutionality. So the court here, they cited case law that stated that the rule that income is not taxable until realized is based on it's more of an administrative convenience and not an exemption from taxation. So constitutionally, there's no realization requirement. It's not required to be considered income. And they also cite other case law that provides that there's no constitutional ban on Congress to disregard the corporate form to tax a shareholder's income, even where there is no actual distribution made. And then also in addition, they pointed to other cases where for such as like in the context of partnerships, which provided that whether or not a partner's share of the net income of the partnership was distributed or not wasn't a factor as to whether it could be taxed. And one of the other pretty interesting statement here that they do mention that subpart F only applies to U.S. persons owning at least 10% of its CFC, whose degree of control over their foreign corporation allows them to treat the corporation's undistributed earnings as they see fit. The interesting thing about this statement is that they do say, like, they're saying a 10% owner in a CFC has the power to compel distributions from the CFC, which as a 10% shareholder, it's still a minority shareholder. So that alone doesn't give that minority shareholder the power to compel distributions. So that's a interesting statement that they they mentioned in the case. Um,
Yeah, and to add to that, Calvin, I think a lot of times we see more often the corporation, the U.S. parent corporation owning a majority of the foreign sub, but in terms of just like the Moors, where they only own 11%, a lot of times individual investors have a minority interest. So that's something, as we discussed further, that's something that I think is really interesting in terms of how this is going to go.
yeah, thank you, Lindsey. Yeah, that's it does factor into some of the considerations that we'll touch on the next slide too. Um, but essentially, the other statements that we listed here just support the court's reasoning as to why the 965, the mandatory repatriation tax, is a constitutional tax. However, I just want to mention, just very interesting, like one of the dissent in the Ninth Circuit decision. They stated that in the dissent, the judge stated that they would read in a realization requirement into the 16th Amendment, even though there's no requirement that's stated in the text. And they pointed to a rather famous tax case, Eisner versus Maycomer, which essentially said that there has to be a realization event to be income. So the court pointed to Maycomer, but they also they admitted that yes, the case doesn't establish a universal definition of income, but the definition should require a realization requirement to be considered income. And the dissent does go on to say that the majority decision essentially allows an apportioned direct tax on unrealized earnings, unrealized income, without limiting it in any way. So it does open the door to new federal taxes on wealth and property, while being categorized as an income tax at the same time without apportionment. So on the next slide, there's we list out the possible outcomes and scenarios that the Supreme Court could decide how they could ultimately decide this case. Although just with the caveat, no one knows what the Supreme Court will ultimately decide. These are just our thoughts on some possible outcomes here. The first outcome is that the U.S. Supreme Court hears the case and they completely dismiss it. They're essentially saying that they side with the IRS and that Section 965 is good law, and essentially real realization is not a factor, not a constitutional requirement for imposing a tax on income or what is income. The second option, the second route that the Supreme Court could take that we could say it could go that way is that they could issue a narrow ruling where they limit it to certain situations. And one or a couple of situations where they could limit it to is that 965 doesn't apply to individuals because individuals are pretty much cash method taxpayers as well. So they shouldn't realize any income where they never received any income. Or the court could go on and possibly limit it to situations for minority shareholders in a CFC. They can say 965 doesn't apply here, or these accelerated regimes to pick up earnings in the CFC that aren't distributed don't apply to minority shareholders in CFCs because they don't have the power, they don't have the control or the power to compel distributions from the foreign corp to require these income inclusions through 965. And the third possible outcome would be where the court agrees that a realization requirement is necessary to impose an income tax. And with this scenario, it would create major issues and major questions around established U.S. international tax law, such as going back to like subpart F and also the guilty rules. Are those constitutional? Are those good taxes as well? So that could sort of, in a way, upend the whole U.S. international tax space. So some considerations that you may want to think about now while this case is still pending decision or pending being heard by the U.S. Supreme Court. One thing that you could consider if you've paid these taxes is to think about filing a protective refund claim. Generally, the statute of limitations on protective refunds is 3 years from when the original return is filed or 2 years from the time of payment. So while the original filing from 2017 is out of the statute of limitations, there was the 965H deferral election where taxpayers could elect to pay this tax over 8 years. So that is still an option if there were payments made within the past 2 years, then you could think about filing a protective claim for these items. But what about, thinking further, like what about subpart F and guilty? Could you think about filing protective claims for those as well, just while we're waiting for a decision on more? That's just something to consider. But at the end of the day, we'll have to wait and see what the U.S. Supreme Court ultimately decides on this case. And I'll kick it over to Lindsey to talk about the Fari case.
Awesome. Thanks, Calvin. So jumping into another case currently ongoing, Fari versus Commissioner. So this was ruled in the tax court this past April. So Alon Fari challenged whether the IRS had a legal or statutory authority to assess Section 6038 penalties for failure to file a 5471. So background here, Fari is a U.S. person who had a 5471 filing requirement for 2 controlled foreign corporations for which he had a Form 5471 filing requirement, and his interest in these entities went as far back as 2003. So under Section 6038B, his failure to file and pay resulted in the IRS assessing a penalty of $10,000 per year in initial penalties, as well as $50,000 per year in continuation penalties. So we had quite a large bill here. So the issue here where FARI kind of makes the argument that these penalties are not accessible by the IRS is really a result of his view that there's a deficiency in the code. So you'll see section 6038B there, indicating the penalties for failure to furnish information with respect to a foreign business entity. And really, so the ruling came down to in favor of FARI due to the IRS lacking statutory authority to assess these penalties, specifically Forms 5471 with respect to the foreign corporations. And this is because the court noted that in the instance of Section 6038, there was no specific language that, indicated or stated the IRS have the authority to assess these penalties on the taxpayers as well as collect. So without that specific language, the IRS sided with FARI, granted that there was this specific language of authority of assessment in different instances of the code for other penalties. So really, it points to a kind of lacking or a hole in this particular section of the code. And it resulted favorably in FARI's instance. We can head to the next slide. So the impact here is that, so firstly, I'm going to start with the IRS. After this ruling in the tax court, the IRS has appealed this case and it will go up to the Supreme Court. In the meantime, it's likely that the IRS will continue to assess penalties as they have been. But the impact really is if they, in the event that this decision is upheld, the IRS's practice for assessing and collecting penalties under this specific section will be completely undermined and disrupted. And this goes, in terms of taxpayer and in reality, this goes farther than the Form 5471. This section is leveraged for other foreign forms and foreign filings, such as Forms 5472. This form usually comes with a $25,000 penalty, a bit steeper than the 5471. And, we have other filings such as for foreign partnerships, the 8865, foreign disregarded entities, 8858. Might possibly reach over and grab the Form 3520 for foreign trust. Form 926 is a large one with a $100,000 penalty maximum. So if this decision is upheld, it's really reaches out and grabs a lot of these foreign reporting forms. So it's good to be keep this on the radar and keep your eyes open for what happens next. As far as the IRS process of assessing penalties, so if this decision is upheld, the IRS doesn't have the authority to assess or collect your foreign reporting failure penalties. So the IRS naturally would have to go the civil route and reach out and continue with the Department of Justice. And obviously this points to a large administrative and judicial burden for both the IRS and the taxpayer in this penalty process. So in conclusion of that point, I think on the face of this decision, it naturally looks like it is in favor of the taxpayer advocate in this sense. But given that if this decision is upheld, it leads to an administrative burden. I think in the respect to the taxpayer as well as the IRS through this process. So I think it's definitely important to keep your eyes open. Actions available to you or the taxpayer. Obviously, the best course of action is to get your ducks in a row. Make sure you stay above the fray with this issue. But in the event that you were assessed on penalties for any of the applicable forms in the past or in current times, determining what you have paid, what you have been assessed to pay, and then speaking with your advisor, seeing if there are options to file a protective refund claim, as Calvin went into previously, on a protective basis while we await this ruling to become final. So there are options to kind of benefit from how things are going on a protective basis. And ultimately, it'll come down to what happens in the Supreme Court.
Yeah, and also just to add that the claiming the refunds on a protective basis and the state of how the procedures may come down, how things may change, it's likely going to lead to a lot of litigation. You may want to also consider just avoiding litigation and just dealing with any assessed penalties, kind of like the old-fashioned way. Either if you can claim the first-time abatement or use any available delinquent international information reporting procedure, it might be just easier and less a drain on resources to go those routes. So that concludes our section. So we'll hand it over to Marina and Andrew to discuss more about transfer pricing.
Thank you, Calvin and Lindsey. And now we're going to be moving on to transfer pricing. And Marina unfortunately couldn't make it here, so I will be playing the role of Marina today. And we have Andrew DeSimone here to talk to us about transfer pricing and give us an update about what's happening around the world and in the U.S. with transfer pricing, obviously a big international tax issue. Andrew.
Thanks, Kimberlee. So I'm just going to get started here, and I'm going to spend the next bit of time kind of just updating you on some of the recent events, that took place in the transfer pricing world. I'm going to kick off with the current climate of the U.S. And listen, I'll be honest, I'm just going to rip off the Band-Aid here. I think we could expect more transfer pricing audits in the not so distant future. As a result of the Inflation Reduction Act, about $80 billion in IRS funding has been earmarked for tax enforcement, increasing the odds of transfer pricing audit and also allowing IRS officials, to not only strengthen their transfer pricing team through increased staff and technology, but also, as a result of that, taking a little bit of a different approach that we've seen in the past. Now, do I think a lot is going to change? Probably not beyond the amount of transfer pricing audits that we will see, but I think we could see an impact on the approach that the IRS is taking. Typically, the IRS has relied on historical or classical transfer pricing methods, the CPM, the CUP. However, due to this increase in funding and available expertise, we do expect an increase in the acceptance of unspecified methods, of course, in certain cases. Now, the IRS is saying this now. If that actually does come to fruition, who knows? But that's what we're hearing, that the traditional transfer pricing methods might not just be the only thing relied upon by the IRS, but also some unspecified methods, which creates a little bit of uncertainty in the transfer pricing environment right now.
Do you think the IRS has kind of low-hanging fruit that they're going to immediately go after as they start to audit
Yeah, I think we'll have the big guys, right? We'll talk about some of those cases later on in this presentation. But I think they're going to also test a lot of these new developments on some smaller companies, so they're not as in the news and not in the front page of the newspaper. We're seeing more audits at the state level. There was a big case recently in South Carolina regarding some issues and debate on the cost plus markup being charged intercompany, but that was all domestic. We typically see transfer pricing as more of an international event, but we're seeing more and more at the state tax level. And with this additional funding, I think we'll probably see more of that. And also, that low-hanging fruit you mentioned, I think leads nicely into that last bullet with the significant interest in intercompany loans and interest rate calculations. That's kind of that low-hanging fruit where they'll see an opportunity to get real money from arguing against some of those interest rates being charged between related party entities.
And especially where you see a lot of times where rates aren't even being charged.
Yeah, a lot of the time we see rates not being charged, and also account receivables, account payables just sitting there that should be being treated as loans and have interest charged to them.
Yeah.
In this next slide, I really just wanted to kick it off with just an understanding of, how large in scale this has become, in terms of transfer pricing compliance. Right now, we have over 150 countries that adopted transfer pricing regulations, most of them aligning with the OECD. And for those that don't know what the OECD is, it's kind of a global think tank that's goal is to align countries from a tax compliance perspective and avoid, profit shifting and whatnot. 100 plus tax jurisdictions impose penalties related to transfer pricing adjustments, ranging from fines to imprisonment. So, it might be a good idea to do a little research before, you enter into a country and do some business there, at least from a transfer pricing perspective. But by far, I think from a regulatory standpoint, the biggest development was in Brazil, where they significantly changed their transfer pricing rules, closer aligning with OECD guidelines. What does this mean? Arm's length standard, interquartile range, more aligning to the methods that are typically utilized by the U.S. and other OECD member countries. Now, I think, it's important to, in these situations, contact your advisors, really get to understand how the changes here impact your company if you're operating in Brazil. If you do conduct business in Brazil, there's not only new compliance obligations here that you have to understand, but also potential planning opportunities that'll give you an ability to reassess your intercompany policy, specifically between Brazil and the U.S., but of course between Brazil and whatever other country you may be operating in.
And this says that you can adopt for this year, for 2023, but you must adopt for next year. Are there any benefits for adopting in this year versus next year?
Yeah, from everything we're seeing right now, we're recommending waiting to 24 when it's mandatory. From what we're hearing, early adopters, although it might look like you're taking that kind of initiative and trying to get it right and taking that extra step, it's from what we're hearing, almost everyone that will adopt early in 23 will get audited. So it's what's, I don't really see the benefit in doing it if it's almost a shoo-in that you're going to get audited if you go through the early adoption process.
Okay. But that seems like it's a lot of changes for Brazil. So if you're doing business in Brazil, how do you keep up? I mean, it's a lot of changes. So get ready.
Yeah, and I think we're seeing that reflected in how the tax agents in Brazil are combating that. They're bringing in a lot of outside resources from advisors, experts, economists that are more familiar with these concepts than maybe some of the agents that currently have historically working for the Brazilian, tax agency. We're seeing a lot of that.
Seems that happens a lot in the tax world where business
Yep.
moves way ahead and tax catches up. This is almost like the tax is moving ahead and now business is catching up.
Yeah, and instead of relying in house, they're looking outside of Brazil to kind of help them get on top of this a little faster.
Mm-hmm.
And I think that leads nicely into our next slide, transfer pricing litigation. We're seeing more and more of these. The biggest one this year was Microsoft, where the IRS claimed they owed $28.9 billion in back taxes plus penalties and interest. That number is most likely driving probably to over $40 billion.
Wow.
$40 billion. And I think it's interesting when we look at this, what the IRS is focusing on, right? They're focusing on IP. And we always said that's kind of like the epicenter of transfer pricing and what matters the most, right? IP. And we're seeing that not only in the Microsoft case, but actually a case in Brazil with 3M, where the IRS is arguing that the Brazilian entity should have been paying royalties as well to the U.S. related party. So that last bullet, I think, is critical if you take anything, from this slide. The importance of economic substance, IP ownership, and allocation of profits. You have to have that documented and tight, ideally in a transfer pricing study. And I think what this does is really stress the importance of having a robust transfer pricing study done. So you're telling your story to the local tax authority as opposed to you having nothing and they're dictating, the facts and circumstances surrounding the intercompany transactions that you have amongst your group of companies.
Any other litigation out there besides Microsoft that we should be aware of?
I would say outside of Microsoft, I would say the one that piqued my interest the most was probably that 3M Brazil case where they were really going after the IP and the royalty payment between Brazil and the U.S. And why that interested me the most was because of everything that's happening in Brazil. I'm wondering how that's going to change. Right, under the new regulations, if the approach they take, the method that they argue is the right method will change because of the new developments as a result of the new transfer pricing laws in Brazil.
Right. You use the acronym OECD, the Organization of Economic Cooperation and Development. And so for people who don't know what BEPS is, you refer to base erosion. So BEPS is base erosion and profit shifting. And this has been a long-term initiative of the OECD to try to get the world players, the world business, to play nicely in the sandbox. So I'll turn over pillar 2 to you.
Yeah, no, this is probably the biggest thing in the transfer pricing world right now. We have that pillar 1 and pillar 2, with pillar 1 amount A and B, with amount A reallocating taxing rights over 25% of residual profit of large M&Es to jurisdiction where the customer and user of those M&Es are located. Basically taking 25% of those residual profits and saying we're going to allocate and tax them where it's sourced. Doesn't matter if you have employees there, doesn't matter if you have an entity there, but where that profit was sourced from. And then amount B, which I think has been probably of a little bit more interest to some, is this simplified and streamlined approach to the application of the arm's length standard. Essentially, what this is doing is which was just released, using a pricing matrix for sales agents, for distributors, essentially saying, hey, this is what the expected profit is for these distributors, these sales agents. And it's a way of saying, it was a way to kind of step aside and simplify it by saying, hey, if you're earning within this range, this pricing matrix, and you meet all these facts, you don't have to worry about getting audited, right? You're basically, you're doing it the right way. It was a way to kind of focus more on cases that are going to be more egregious manipulation of transfer pricing rules. And then pillar 2, you have that global minimum tax of 15% on M&Es with annual revenue over 750 million. And I think if we probably skip over the next slide and go to the slide after that, we're going to talk a little bit more about new development there. And this just happened as of recently of October 11, 2023. The OECD G20 released a handbook, the Minimum Tax Implementation Handbook. The handbook provides an overview of key provisions of the global minimum tax and considerations to be taken into account. I certainly suggest you read it. But more importantly, I think you contact your advisors and you ask your questions, because this is going to impact pretty much everyone. And it's not easy. I had to read it a few times to kind of wrap my head around it. So I think what you should take out of this is you're going to be impacted by it. Contact your advisors. And at the end of the day, no matter how much the rules change, the robust documentation in the transfer pricing study is your best friend in making sure you're documented and covered and protected and telling your version of the story, as opposed to those tax authorities coming in and telling theirs.
Great. And what kind of companies would be most impacted by all of this? Any business doing business abroad and working with related parties, as long as you have your transfer pricing and you follow our rules and you protect yourself,
you
should be okay. Just get
Pillar
that 2, good advice.
Yeah, so Pillar 2, it's really for the bigger companies, right? Anything over 750 million,
50 million
right?
euro.
For Pillar 1, in particular, that amount B, you're really looking at commissionaires, sales agents, and distributors that's really going to cover. And that amount A, again, covers a broad range of companies, but I think the companies that are really going to be impacted by most from that are the digital companies, right? Where, the Amazons of the world, the Netflixes of the world, where you're sourcing income from so many different countries, but you don't necessarily have a presence there.
I would just say, when you're doing business internationally, it's important that you get your advisors in and talk to them right away before you go, while you're over there, while you're working abroad. Asking questions and getting advice is key before you go and while you're there. And through Withum, through Marita and Andrew, through our colleagues through HLB overseas, we have the resources. We have a great team of people that can help you. So I encourage you to reach out and ask us questions and let us help you protect yourself and get the right answers as you go. Thank you, Andrew. This has been great.